This is Peter Schiff. It is Monday, March 18th, 2013. The big news over the weekend is yet another European bank bailout, this time for the tiny island nation of Cyprus. Cyprus, due to its close proximity to Greece and the fact that banking is such a large part of the Cyprus economy, their banks are in trouble because of all the money they loaned to the Greek government. If you recall, there were 2 rounds of haircuts given to Greece's creditors, one of those creditors being, or several of those creditors being, banks in this tiny nation of Cyprus. The banks are now insolvent, and the ECB just announced that they would bail them out. Now, normally that would be another day, another bank bailout. But what's different about this bailout, and that what makes it very significant, is that this time the depositors are going to lose money. Now, if you look at all the other bank bailouts that have taken place, either on this side of the Atlantic or the other, the depositors have basically been untouched. Now, I think this is a big problem. I think government insured deposits is the reason, the primary reason, that banks are so reckless. It's the moral hazard. The depositors know that they're going to get their money back no matter what the banks do with it. So depositors don't care how much risks the banks take. In fact, they love it when the banks take risks because then they can earn more interest or get free services. The banks know that their customers don't give a damn how much risk they take, so they take plenty of risk. And so because of deposit insurance, the banking sector is much riskier than it would be absent that insurance. But what's significant this time is that in Cyprus, they had deposit insurance, just like we have in the United States, just like they have, unfortunately, in other European countries. The government basically said that your deposits up to 100,000 euros are protected in this deposit scheme. Well, the new bailout plan that was just announced includes a tax, I guess that's what they're calling it, on bank deposits. All deposits of 100,000 euros or less are going to be taxed 6.75%, and any balances that exceed 100,000 euros are going to be taxed at 9.9%. So in other words, in this bailout, it's the depositors that are going to be asked to take a haircut. Of course, the depositors don't like this. They're losing money. Now, had there not been a bailout, had the European Union not stepped in, it's likely that some of these banks would have failed, and the government probably wouldn't have had the resources to make good on the deposit insurance anyway, and the real losses for the depositors would have been even bigger had there been no bailout. But of course, so far the depositors have been spoiled in that no matter what happened, they've been made whole, at least nominally. They might not have been made whole in real terms, and I'm going to get into that in a minute, but they've been made whole nominally. But not this time, although there's still time maybe for the government or the ECB to try to change policies, although I think that would be a mistake. But for now, it appears that the Greek depositors are, not the Greek depositors, the Cyprus depositors will lose money. Of course, a lot of the people with money in Cyprus don't live in Cyprus. It's a big offshore banking center. You have a lot of British, for example, that keep their money in Cyprus. In fact, I think the British government has already offered to reimburse British soldiers who have accounts in Cyprus for their losses. But what's more significant about this is what it might do to the psychology of depositors. And this is where the problem potentially comes in. The real reason we have deposit insurance, it's not really to protect the depositors. It's to protect the banks. And in particular, it's to protect the banks from runs. Because remember, we have a fractional reserve banking system. And what that means is that banks keep a very small percentage of their deposits on reserves. They loan it all out. And sometimes they make bad loans, like loaning it to the Greek government. But the problem is, just about every bank in the country, in the world rather, if a significant percentage of its depositors wanted their money back, they couldn't get it. And one of the reasons that everybody doesn't ask for their money back is because they're confident that they can't lose it because there's some government insured scheme behind it. Well, That's what people thought in Cyprus. But now it turns out that the deposits weren't protected. The fear for the Eurozone is not about this little nation of Cyprus, but what might happen in Spain, what might happen in Italy, what might happen in Portugal, what might happen in Greece. What happens if people that are operating under the assumption that their deposits are insured, what if they begin to doubt it? Now, you already have officials claiming that, well, Cyprus is a special circumstance and it's not going to happen again. Well, they can't guarantee that. It's kind of like President Obama saying he has no intention to drone American citizens. Intentions don't have anything to do with it. I mean, intentions can change. And if people begin to doubt the deposit insurance, they're going to go to the banks who want to withdraw their money. After all, why take a chance? I mean, a lot of the banks are barely paying any interest anyway. So what's the point of leaving your money in there if you think there's going to be another Cyprus? Now, of course, the governments are always going to deny they would never do it, but actions speak louder than words. And if it happened once, it might happen again, and there is the problem. Ultimately, the same thing is going to happen in the United States. We've got deposit insurance here in America, but eventually we're going to be faced with a similar problem because when interest rates rise and big banks fail, the FDIC doesn't have the money for a bailout. And if the Fed is tightening, the Treasury doesn't have the money to bail anybody out. So we're going to be in the same situation. It's interesting. I read an article in Forbes on the internet. And the author basically said that this was stupid, this was terrible what Germany was doing, this was a dangerous precedent that they were setting, and they shouldn't let the depositors, these Cyprus depositors, lose any money. But in the same article, he also criticized Germany for not creating enough inflation. Now, you see the dichotomy there because he's upset that Germany is going to allow bank depositors to lose money, but he doesn't care at all about inflation destroying the value of those deposits. You see, depositors are going to lose one way or another. Either they're going to lose their deposits to a default or a tax, or they're going to lose the value of their deposits. Their deposits will lose value due to inflation. But either way, depositors are going to lose. I think the irony of it is, and maybe in the United States, I think if the Federal Reserve creates enough money to bail out all the banks so that the depositors don't lose their deposits, I think they will lose more real purchasing power that way to inflation than if we had a more honest approach where the depositors were asked to actually take a haircut. Now, we'll see how the markets are going to respond to all of this. I think, first of all, that this is a very positive development for gold. Now, the reason for that is that bank deposits are at risk, and if you think your money is at risk in a bank and you pull it out, what are you going to do with it? Well, putting it in gold is a great alternative. In fact, if you had euros deposited in a Cyprus bank, now you've lost about 10% or close to 10% of the value of those deposits, or 10% of your euros. But if you had gold in a safety deposit box in a Cyprus bank, you haven't lost an ounce. So the people who have gold are whole, and those who had euros or I don't know other currencies you had on deposit, but they've had a loss. So this highlights the safe haven aspect of gold. Now, one thing that might undercut the rally would be a sell-off in the euro relative to the dollar. Now, I also think that's temporary. People are going to be worried about how this is going to play out. People are going to panic. This is bad for the euro. But ultimately, this is actually good for the euro, at least relative to the US dollar, because allowing depositors to lose money is good economics. It might feel bad in the short run, but it leads to a sounder banking system. It leads to less moral hazard. In the short run, that might not be the case, and so probably see a sell-off in the euro, a little rally in the dollar, and that would somehow limit the appeal of gold in the short run. But ultimately, and I don't think, again, this is not going to be years in the making, but I think that people will appreciate that this is a positive step. The fact that the depositors are sharing in the losses is a major step forward in banking, not a step backwards. I believe that more countries should get rid of their deposit insurance and have a free market. Because if we have a free market in banking, then there will be much higher reserves and you won't have as much of this reckless lending that has gotten the world into so much trouble. Now, if you happen to have money on deposit in a bank that has a lot of leverage or in one of these countries, you might be concerned right now. One thing that you might be able to do is close your account and open up an account if you're not a U.S. citizen at my bank, Euro Pacific Bank. You can check out my website at europacbank.com because among other services that I provide at my bank, one thing is we don't make any loans. We have 100% reserves. There's no fractional reserve banking. So all of my depositors can get all of their money on the same day. It doesn't matter. So if you're concerned about something like that happening, and I think that there is reason to be concerned given the incredible instability in the banking sector, I think you have to find banks like mine where you can be confident that your deposits are secure. But more than that, you have to be concerned about what currency you have on deposit. Because just because you're bailed out, just because you're made whole in terms of how much money you get, doesn't mean you're made whole in what that money is worth. In fact, most central banks will be willing to destroy the value of those bank deposits rather than officially do what has just been done in Cyprus. And of course, the public is going to scream, nobody likes to lose money. It's much easier for the politicians if their money loses value instead, especially if, like they're doing in the United States, you lie about it, you pretend that prices aren't rising, and then when you finally acknowledge that prices have gone up, well, of course, you blame it on the speculator, you blame it on greedy corporations or whoever, but politicians will never blame it on themselves. One more thing I want to talk about today is President Obama. He recently came out and said that he doesn't believe we have a budget crisis, and he said that our budget deficits, the way they are now, are sustainable for the next 10 years. Now, first of all, that's very different from what candidate Barack Obama said about the deficits when he was running against George Bush, and he talked about how unpatriotic they were when they were about half their current size. But be that as it may, I want to take issue with what the president is saying. Now, technically, he might be correct in that there is no budget crisis today. But he is very incorrect if he believes that the situation is sustainable for the next 10 years. It's not. Because as soon as interest rates move up, we will have a crisis. The crisis is inevitable given the current trajectory and the size of the deficit the way it is. So to say it's not a crisis because the situation hasn't blown up in our face doesn't mean that it's not imminent. In fact, you could have gone back in 2004 and 2005 and said there was no housing crisis. In fact, that's what just about everybody said. But the housing crisis was already inevitable. It was in the making. The bubble was inflating. The fact that it was going to burst was a foregone conclusion. The only question was when. So that didn't mean we didn't have a crisis. It just meant that we weren't dealing with the crisis. That's the same thing now. We have a crisis. We're just choosing not to deal with it because right now we don't have to. The crisis hasn't come to a head. Now, of course, if we were going to be preemptive and get ahead of the curve and deal with the budget deficit now, it would be a crisis. If we were forced to deal with the debt right now, it'd be a crisis for a lot of people because the government would have to slash spending dramatically. And a lot of people would suffer. The economy might be in a deeper recession, especially if it's accompanied by a big increase in interest rates, which I think is inevitably a part of the solution. But just because we're not having that crisis now doesn't mean we don't have to worry about it, because the longer we wait to deal with it, the worse it's going to be. I mean, we can either confront the crisis now on our own terms or wait until circumstances force us to deal with the crisis on much harsher terms. See, that's all President Obama is doing. And Obama doesn't really care if it's sustainable for the next 10 years. He's just hoping it's sustainable for the next 4. because then his term is over, and we can blame the collapse on the next, or on the next president. But I don't think the president is going to get that lucky. As I said in the last video blog, I don't think he's going to get out of Dodge the way Bill Clinton did. George Bush didn't make it out in time. I don't think President Obama is either. But this is a big crisis. Eventually, the same thing that they're dealing with in Cyprus, we're going to have to deal with in the United States. And I think it's going to be bigger. I think a 10% haircut, we would be lucky to get away with such a trim. We're going to get a crew cut on our bank deposits here in the United States, one way or another. Either it's going to be an honest way, similar to what they're talking about in Cyprus, or it's going to be dishonest because the Federal Reserve is going to print all the money to prop up all these insolvent banks. But either way, the losses are going to be horrific, and it is a crisis. Just because it's not imploding, right? There was a crisis in Greece 2 or 3 years ago, just that nobody knew it until it erupted. Now you've got the same thing in Cyprus. For politicians, it's only a crisis if it happens, if it collapses while they're in office. And if they can postpone it to after the next election, as far as they're concerned, it's not a crisis. Because the only crisis our leaders care about is the one that endangers their desire to be reelected. That's it for today. Make sure and continue to listen to me at shiftradio.com as we cover this developing story. Bye for now.